Good day! I am ERRA TORIBIO, a reporter from Group 8, and I will report about Module 3, Understanding the Importance of Financial Concepts. Let's go to the introduction. Individual study, workshops, and seminars, and on-site training may all be utilized to successfully use understanding financial statements or organization's cash flows. Management, in anatomical metaphor, like the brain, marketing is the muscle and finance blood, is generally characterized by management. In the absence of financial considerations or understanding of the economic condition of a company, the brain becomes non-communicative and the muscle malfunctions. Understanding the fundamental finances of good cash control is crucial to the survival and success of any business. Meaning you have to understand the fundamental matters about finances. It is important to understand how a balance sheet and profit and loss statement may be interpreted to teach you how to manage the company and to handle it is intended. Before making recommendations for changes to procedures, operating systems, budgets, and other financial control activities, the finance department evaluates financial reporting systems, accounting and collection methods, and investment operations. Finance management is in charge of documenting a company's working activities, as well as measuring its profitability and reviewing profit, margins, net income, and losses. It allows the department's financial analysis capacity to use prior and current data to compare how well the firm's financial performance is performing, and if necessary, an action plan will be presented to the management. By delivering comprehensive financial statements such as balance sheet, profit and loss statement, cash flow statement, and statement of shareholders' equity, it ensures the correctness, completeness, and consistency of data. Financial risk management is critical for identifying pricing and monitoring the risks that the business faces. Investment analysis is a function that focuses on tax planning and involves a tax specialist analyzing working capital ratios to evaluate financing needs in operations. At the end of this module, students should be able to 1. Demonstrate awareness and understanding of the financial function's overall role and relevance. 2. Establish fundamental understanding and knowledge of financial management. 3. Mastery of fundamental financial terms is required, as is effective communication using conventional corporate vocabulary. 4. Determine the fundamental context of financial and institutional entities. 5. Analytical assessments of financial outcomes, proposals, and strategies are performed. 6. Determine your finance sources, instruments, and markets. 7. Demonstrate understanding of the evolution of money's value and its applications. And lastly, recognize the significance of ethics. Thank you, and let's proceed to the next reporter. Thank you.
Good day everyone, I'm SHERWIN BALAYONG, and let's start our lesson 2, Financial Statement Analysis. Financial statements are the records kept of a company's financial activities and position. They aim to educate people both inside and outside the organization about the company's financial situation, profitability, and changes in the economic status. Next is Lesson 3, Working Capital. Management of working capital described as a current assets minus current liabilities. It is an economic approach that helps firms that best use of current assets while retaining enough cash flow to meet short-term goals and financial obligations. Now let's move to our Lesson 4. Short-term and long-term financing. Short-term financing refers to the financing of the company for short-term sources. For time being frame of less than 1 year, and it assists the firm generating revenue for working investment and operational expenses, which are typically for a smaller amount, and it has involves generating cash through digital loans, credit cards, and payment of bills. Now let's move to our advantage of short-term loans. First one is less interest. Less interest because it is are to be repaid of in let relatively short amount of time, usually within a year. The total rate of interest cost will be less than of long-term loans, which take several years to pay off. The overall interest expenses of a long-term loan may be greater than the outstanding balance. Next is disburse quickly. Because they have a longer payment schedule, the danger of loan delay payment is lower than its long-term loan. As a result, because the settlement date of short-term loan is shorter, it takes less time to get approved. As a result, the loan can be approved and funds released swiftly. The next is less documentation. Because it is hazardous, the paper necessary for the same will be little, making it an alternative for everyone to pursue for relative brief loans. Now let's move to our disadvantage of short-term loans. The main disadvantage of short-term funding is that they only allow for lower amount borrow and shorter time of maturity, so the lender is not saddled with larger repayments. Now let's move to long-term financing. Long-term finance is mostly used to support key capital products or to grow the company's business activities. These funds are frequently used to invest in initiatives that will provide synergies for the company in the coming years. Now, let's move to advantage of long-term financing. The benefits of a long-term financing correspond particularly with the organization's ultimate capital objectives and its controls to the organization's asset liabilities situation. It also includes a long-term assistance to a shareholder and the firm in the development of efficiencies. The next one is limitation of long-term financing. Since it is long-term, so it must have limitations. It limited to strict rules imposed by authorities for payback of interest and the principal amount. So that's all, and thank you for listening. Let's move to our next reporter.
Okay, good afternoon. I'm KERWIN VILLAVERDE, BSE 3C. I'm going to present the strategic management. Lesson 5, time value for money. Time value for money, the notion of time value of money states that quantity of funds is worth more now than it will be at later period due to its learning potential in the interim. Value of money is another name for the time value of money. This is due to the fact that money can only increase by investment. An investment that is postponed is a missed opportunity. Understanding the time value of money in financial management. Every investor should prepare to receive money today rather than the same amount of money in the future, since money increases over time after it is invested. What is the relationship between time value of money and opportunity cost? Administrate investment decision in marketing choices. Capital budgeting is critical investment decision that take time to process and mature, must be founded on the profits that the transaction venture will provide. What is the importance of time of value money? The time value of money area can assist, influence, and investing choices and considerations in decision making. In finance, how is the time value of money used? Use time value of money calculation to ensure that their account holder have adequate money to retire. It would be impossible to find a single area or finance where the time value of money does not influence decision making. The time value money is the fundamental concept of evaluating and investment opportunities. Lesson 6. Risk and return. Risk and return is a financial concept that is similar to gambling. The risk trade-off of equilibrium state that when risk grows, so does the potential rewards. Understanding the optimal time for the risk-return trade-off is financial theory that argues that the bigger the risk, the larger the potential rewards. Lesson 7. Capital budgeting. Capital budgeting, or known as financial planning, is the technique for assessing the financial sustainability of an investment capital across its entire life cycle. What is capital budgeting and why it is so vital for the effective planning? The capital budgeting approach enables company to quantitatively analyze the long-term economic and financial sustainability of any investment proposal. A capital budgeting decision entails both cash or obligation and investment. That would be all. Thank you. Kasi wala ko yung